Hello there. Welcome to our yet another very interesting discussion on process costing. This is our lecture 1 that discusses the various issues surrounding process costing. Now, this lecture forms part of our Cost and Management Accounting Masterclass. And if you are a student under the Certified Public Accountants CPA or SCCA, I highly recommend you to purchase the full course. The masterclass is also highly recommended for all students undertaking Cost and Management Accounting as a course unit, either if you are at the University or Institute of Higher Learning. This is a highly recommended course for you to purchase. I will leave a link below this video that can direct you to our sales page, where you will see more of the details about the masterclass. Don't forget to subscribe to our YouTube channel so that you can be able to receive more of these educative videos. So I'm going to take you straight to the discussion or our lecture into process costing. And of course, as you can see, we begin by understanding what is process costing. So process costing is a costing method used where it is not possible to identify separate units of production or jobs, usually because of the continuous nature of the production processes involved. Some of the examples we can cite when it comes to process costing include oil refining, paper production, food and drinks, and chemicals. Now you find that in all these cases, the product goes through various stages or various processes. Now the features of process costing, of course, there are 4 major features that we bring out here. Number 1, the output of one process becomes the input to the next process until when the finished product is made in the final process. And then number 2, we are saying that the continuous nature of production in many processes means that there will usually be closing work in progress, and of course in most cases this must be valued. Number 3, we are saying that there is often a loss in process due to the spoilage, wastage, and evaporation. Then number 4, we are saying that output from production may be a single product, joint products, or by product. So these are the 4 major unique features of process costing that I can bring forward for you to appreciate. Now again, what is very important when it comes to process costing is the flow of costs. So of course, for us as management accountants, our major concern is the costs. We need to track these costs. So it is important for us to appreciate the flow of costs. So in the discussion, we are saying that in process costing industry, production moves from process or department to the next until completion, until the final completion occurs. So that is how production will move from process A to process B, from process B to process C, until when we have our finished goods that are going to be kept in stores. Now each department or process performs some part of the total operation and transfers its completed production to the next process or department. And in the next process or department, the work in progress becomes the input to further processing. And as you can see on your screens, what comes from process A becomes the output from process A becomes input to process B. Output from process B becomes input to process C until when we get the final product from process C, which we have said the final product can be a single product, they can be joint products, or by products, as we are going to see. Now it means that the operation carried out by one department or by a given particular process is completely different from the operations carried out by the other processes or departments. So the aim of the operation carried out in any of these production processes or departments is to change the raw material into new and improved form. So whenever we have output from process A, for instance, and goes to process B, we expect that as it comes out of process B, it is in a more improved form as compared to when it came out of process A. So that is the aim of each of these processes. And of course, we continue by saying that the cost per unit or the unit cost of each product is determined at every stage, at every process. So we determine the cost per unit at each stage, at each process. And to determine the cost per unit, we use the general formula showing on your screens right now. So the unit cost is going to be computed as the total process cost minus the scrap value of normal loss divided by the expected output. Now the expected output, of course, is going to be the input minus the normal loss. Again, at every process, we construct an account which we call the process account, plus other accounts that are necessary, like we shall see the scrap account, the abnormal loss account, loss accounts. So all these accounts are going to be debited and credited with the various costs involved. So we are saying that at every process, a process account and other accounts are opened, and these are debited with all resources or costs incurred in carrying out the operation, and the resulting accumulated costs representing the cost of output are credited to the same account. Other items like gains registered and the losses incurred are debited and credited to the account respectively. We are going to see the format of the process account. Actually, that is our next slide, the process account. So typically, our process account will look like this. Of course, like any other account, it has the debit side and the credit side. And as you can see on the debit side, we capture the item. We capture our item here. We capture the units, the unit cost, and the amount. So that is typical of the process account, both on the debit and on the credit side. So on the debit, we shall capture the material costs, the labor, overheads, plus the abnormal gain. On the credit side, we capture the normal loss, output, abnormal loss, and the closing stock. Okay, and the closing stock. So basically, that is our process account, and of course, it has a role it plays in the general management and cost accounting process. Now, what is typical regarding process accounting is the framework, the 4-step framework. So when we are handling process costing, there are particular steps that we take. Step number 1, we determine the output and the losses. We determine the output and the losses. Now, these are going to be very important steps for you to manage this area, and it has very good marks. Then step number 2, we calculate the cost per unit of output. We calculate the losses and the work in progress. Step number 3, we calculate the total cost of output, losses and work in progress. And then step number 4, we complete our accounts. Of course, typical is the process account. So this is the summarized framework for dealing with process costing. Very, very important framework. So in step number 1, of course, as I've mentioned, we determine the output and losses during the process, and this is going to involve determining the expected output. What is the expected output? It involves calculating the normal losses and abnormal loss or gain. It involves calculating equivalent units in case we have closing or opening work in progress. Now, the equivalent units will not come in if we don't have closing or opening work in progress. So that is what is involved in step number 1. We determine the output. What is the output in terms of units? And the losses. As I mentioned, losses are normal and are expected in the entire process. Number 2, in the framework, we calculate the cost per unit of output. I showed you the formula, the losses and the work in progress. This involves preparing the statement of equivalent units. Then under step number 3, we now calculate the total, okay, for everything. The total cost of output, total losses, work in progress. If we have any closing or opening work in progress, this step will involve preparing the statement of evaluation, what we call the statement of evaluation. Step number 4, the last one, we prepare the accounts. As you have seen, we prepare our accounts, and of course the major account is the process account, which we have already seen in the previous slide. So as I've mentioned, the process involves losses, and of course management accounting has a criteria for dealing with these losses. We have a way we deal with these losses. So how do we deal with the losses? Of course, we are saying that in most manufacturing processes that involve process costing, there will be losses occurring between the processes. A loss occurs when the quantity of material output from the process is less than the quantity input. You see that? A loss occurs when the quantity of material output from the process is less than the quantity that was input. So if we get 5 kilograms out of the 9 that we input, definitely there is a loss. It might be more satisfactory to take long-term view and calculate average unit costs on the basis of the average loss over a given period of time. When it comes to treatment of losses, the cost of normal, there is what we call the normal loss, which is the expected loss. Now, the cost of the normal loss is spread across the expected complete unit of goods output in the same way as the costs for materials and labor to arrive at a unit cost of production. So we spread this normal loss is going to be spread across the expected complete units of goods output. The cost per unit is going to be based on expected output, which is represented by the total material input minus the expected or normal loss. So when we are computing, when you look at our formula for cost per unit, we base the cost per unit on the expected out. What do we expect as the output? So what you expect as the output is what you input in the process minus what you expect to lose. Because when we are computing the cost per unit, we base the cost per unit on the expected output, which is the material you have input minus what you expect to lose in the process. However, the loss may become abnormal. The loss may become abnormal, and we are saying that the abnormal loss should be written off to P&L and not offset. Okay, and not to offset valuation of units of goods output. Okay. Now, abnormal loss and abnormal gain. First of all, the normal loss is the loss that we expect to incur during the production process. So that one we don't attach a value. Its cost is 0. However, if it becomes abnormal in the sense that the actual loss is greater than the expected loss or the normal one. When the actual loss that you incur becomes greater than what you expected, then this becomes an abnormal loss. Okay. Then, of course, it is also possible to have an abnormal gain. Okay. This is where the actual loss is less than what you expected. If the actual loss is less than what you expected, then you have made an abnormal gain. So basically the rules are: normal loss is given no share of the process. Okay, normal loss is given no share of the process cost. That is to say, it is valued at 0, nil. Cost of output is going to be based on the expected good output, or the expected output for that matter. Abnormal gains and losses are valued at the same cost as the good output and are charged to P&L. We shall see that in our activity. Any balance on the abnormal gain or loss is transferred to our P&L. So basically, those are the rules of the game. So we shall support the foregoing discussion with activity 1. Shall support the foregoing discussion with activity 1 as we prepare ourselves to go into the exam type questions. So that is our activity 1. I want you to read through or take a screenshot, and then we start on it.